This is Smart Investing with Mike Wren.
Didn't your dad teach you any of this stuff?
He says the only tool you need is a sense of humor.
Because who needs the jaws of life if you have a good knock-knock joke?
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren.
If I'm being honest, I had to get out of there. I was exhausted from having to dumb it down all day.
With Michael's producer, Chris Martin.
Sweet as custard and just as smart.
This show is live. And call-ins are welcome. Or you can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Wren.
Well, good morning, everybody. How are we doing out there today? You have tuned into Smart Investing with Mike Wren, your host, and I am Mike Wren talking to you. I have my producer extraordinaire. Oddly enough, I just noticed this about him, though. His T-shirt it's devoid of any logo. Now, did somebody in the comic world die?
I'm dressing like an adult today.
Okay, you know, normally somebody with a suit walks into maybe an establishment. You don't usually see the person in a suit. And if they're of a certain age, you kind of kid them, who died?
No, this is actually, now I'm going to ruin the whole aspect of it because this is just what I wore last night. Is my new job, basically. Yeah. I leave at 5 and my wife comes home at 5. So we kind of don't see each other for like 4 days.
And Chris was bragging about that for hours on end, calling it Valhalla, paradise, all kinds of things.
I'm just saying, until you taste sweet nectar of it.
He said he got this perfect life and he didn't have to blow himself up with a suicide vest.
That's right.
You already got there.
So we only get to really see each other for like Friday and Saturday, and last night we were going out somewhere, and so I put on a shirt without a
Otis.
logo.
Is it Otis Orchards or Green Acres?
It was actually the Valley, just Post Falls, really.
Woo!
So yeah,
living it up.
I know. So yeah, I thought I'd dress as an adult and wear a shirt without a logo.
That new job, you may just not have to carry proper ID on you because people should know
That's
you.
That's right. Worst awkward moment, though, of my life. Can I quick tell you this?
Of your life?
Oh,
recently?
Yeah. Oh, yeah.
Oh, people, this is, by the way, let me just make a caveat. This is an investment show. We do try to take the topic of investing, number one, make it easier to understand. Number two, get you good relevant information on each and every show. And thirdly, we try to be entertaining. And since we have a total of probably 30 listeners over the last month and a half and probably 3 telephone callers into the show, we're going to take our own time and talk to Chris right now because we know that nobody cares.
Now, this is coming from a guy who's actually worn stormtrooper armor, just the bottom half to the radio show. So,
well, you're usually, let me tell people, he's not a weirdo. He's just, he is a weirdo, but he's usually using his weirdness to raise money for kids or something like that. So go ahead.
I did the ALS challenge, by the way, and I posted it on our Smart Investing Show Facebook page.
Cool.
But
that's how I shower every morning, by the way.
Just a bucket of ice.
Hoorah! Okay.
So my wife works at a place where they get people jobs, an employment service. And I got my other job through her employment service. Mm-hmm. So technically they hired me. So technically they needed a drug test. Now, I've known a lot of stories about how like exes when they're divorcing, all the bad stories and stuff. I have yet heard of one where a guy walks in to see his wife as her boss is standing right there with a cup of urine. I had to walk into her office with a cup of urine and in front of her boss say, "Look at here." Now someone else is testing it, but I had to walk into my wife's business with my cup of urine.
Did she say
next to her boss?
Did she say I've seen this movie before?
You know, and I've really tried for a longest time not to even go to the bathroom in front of her. I mean, we've been married like 25 years, but one time I didn't have a choice. We were camping,
what's cool is you don't have an ex. You've been married the whole time.
I know. So yeah, that was
I might
really
as well
awkward.
be Johnny Carson compared to you.
Yeah, I know. Or Larry King.
I know. You don't have to say that. Jeez, nice
I've known you for long enough.
Skewer of Mike Wren.
I've known you joke about it.
I know. Oh, okay, everybody.
And none of them are listening. So
nice. Hello, everybody. So, on today's show, we can talk about the same old stuff, and we will. The same old stuff is, I don't think that, let's reverse. I think that packaged products are way overused. Most people don't realize that. My industry doesn't realize it from 2 points of view. Number one, they don't want to take the time to have to think about something. And number two, they're too busy selling stuff. My industry, pretty much, unless you're in the upper echelons of mutual fund management where the people are actually making investment decisions first person, like me, nobody else is giving this a thought. That's kind of the divergence of my industry now, is that all of my competitors that I can think of, let's say not all, but the vast majority, most, they guide people into packaged products. Mutual funds, exchange-traded funds, all kinds of things, annuities. And when you distill these packaged products down, you have securities inside them that should be evaluated. Well, the people that do the evaluating are the people that actually run the packaged product, not the person that's my competitor, not the guy at the Edward Jones office. I hate to bring up Edward Jones, but you know, I might bring you up when you're in the Journal of Business and you say, oh, we're going to be expanding in the area and there's already 20 or 30 of you blokes out there and women too. What about that says that you're making money for the clients? Nothing. It says that you as a company are expanding. It'd be just as if McDonald's was opening up 2 or 3 franchises. Does it mean any benefit for you? No. If you're buying something, it means that you can find another branch to find them that might be close to your grocery store. What the hell about that means anything about investing? You're right, nothing. It just means that there is another kiosk that you can go to buy crap from somebody that doesn't know what they're selling. So that ended up. When you walk
out of your Starbucks, you get to turn around and see another Starbucks.
And that ended up to be more negative than I really, really wish. But anyway, I'm of the opinion that if you're going to invest, especially right now, because we are in the great no man's land, okay? Right now, a lot of people don't know how to think about the future. That's the problem. They look at the past and they can understand what went on in the past. 5-6 years ago, the world almost ended. Ha ha ha. Snicker, snicker, quotation marks. So the world almost ended. They can look back, oh, yeah, well, anybody would have been scared back then. So I've recovered right now, and now I'm looking forward. And most of the pundits out there, if you go to Yahoo Finance, Google Finance, any sort of a place like that has editorial comments, which they all are, you're going to find Article A, it's going to say why we're going to have another correction anytime soon. Article B, just below that, why the market's going to continue to go up. Article C, why the market's going to go down a lot more than the guy in Article A thought. And then you have all of this, and it's back and forth.
There was a place that I go to that has news all over the place, and one of the headlines was, the market's about to crash, and it was like Market Watch or something like that.
Sure.
The market's about to crash. Right underneath it, the headline was, market's going to go sky high.
Yeah.
Right underneath it, same day.
So that's why I concentrate so awfully much on, number one, the behavior of you, the listener, you, the investor, trying to make sure that you don't get too greedy or too scared, too fearful. Number two, I try to concentrate on the second thing that we can control, what we own. So if I make the investment decision first person, if I don't farm it out to a packaged product, it means that you and I get to do a wonderful thing. We get to choose what we own. That is extremely powerful because we can own any number of wonderful companies. When we come back from the break, in the next segment, I'm going to try to give you a little bit of perspective as to maybe how you should think a little bit of the future, truly, when it comes to investing. Maybe a talk that Warren Buffett might have with you. And it's the talks that he has with people about looking towards the future are fairly simple, so I don't mind using his name. Number two, most of the packaged products got started with the money market. I'm going to give you the history of how the money market got started and where it came from, so you can understand how the first steps way back in the early 70s of this packaged product boom, how it actually started. And after that, you never know. We might have, it's getting closer to school, we might have 10, 20 listeners on today, so I'll give the telephone number and we'll just see what happens. 509-241-5900. We're on the web at smartinvestingshow.com, and we'll also be right back.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objective, situation, or needs and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.
This is Smart Investing with Michael J. Wren and Michael's co-host, Chris Martin.
We need to stay strong.
But I feel...
Don't feel. Just go splash water on your face and man up.
This is Smart Investing with Mike Wren and Michael's co-host, Chris Martin.
What exactly do we do? Let's just say it's too hard to explain.
Hello, everybody. You're back with Smart Investing. I am Mike Wren, your host, spelled W-R-E-N. I have been in the industry 24 years, so I have a pretty good understanding of what goes on, especially since I worked my way on up from the mailroom at a broker-dealer. So I know how the guts of these places work. So I think it might be a little bit more interesting to me than most folks. And that's why I like the history. And we'll get on with the history at the bottom half of the hour, third segment of the show. But right now, what I want to talk about is how you, the investor, should think, especially if you're actually one of the double-digit listeners right now out listening to the show. Take a look outside. It looks pretty awesome today. It feels pretty awesome today. It is the start of the glorious September days that we have in this area of the world. You can't get any better than this. This is one of the best times in the best geographical locations on the planet. I've been to many cities in the world where when summer ends, it ends abruptly, and you might as well have so much rain, so much cold weather, so much wind that things instantly quit growing, and you've got mud already or moss. And I'm not even talking about Seattle. I'm talking about many, many, many places in Europe. A lot of places get so dry that, it's just too dry. This area of the world is wonderful. Why am I bringing that up? Well, because truly, one of the things, in my opinion, that derails people when they invest is they don't use their real-world skills and their real-world thinking and upbringing when it comes to thinking about investing. Journalism in the United States has screwed all of us up when it comes to thinking about a lot of things. Investing is nothing more than, at least CNBC is not talking about you owning your own home, so that's checkmark number 1 of growing your own wealth. 2, it's not talking about you owning your own business, so that's the second checkmark of how you grow wealth. It's talking about the third checkmark, owning pieces of somebody else's business to grow your wealth into the future. That's what it is. It's nothing more than that. You are owning chunks of business for the future. When you watch CNBC or all these other things, you might think that Wall Street is some version of Las Vegas. Some people make it that way. You might think that it's some Brazilian soap opera. You're right. Some people think of it that way too. You might think of it that it's full of a whole bunch of oligarchs, like Russia. It can be that way too if you think about it. You might think of it as a big clan of a whole bunch of people, a whole bunch of Jewish folks. People think of it that way. A whole bunch of Catholic folks. Years ago, a whole bunch of WASPs. Wall Street's so big that many people can make out of it what they want. But the proper way to think about it is owning businesses. And when you think of owning a business, into the future, my Chris at my office, Chris Brandcamp, where we share office space, we were thinking about this the other day, is that what most of even our clients are losing is the fact that they don't think of businesses continuing on to the future. Okay? Look at MTV. You and I grew up with MTV. It was a simple thing that changed the way the music industry operated for decades upon decades upon decades. It created a whole nother chunk of business out there. Rewind a decade. How many people were using cell phones as ubiquitously as they are today? I don't think very many. A decade, that's all you have to go back. 2004, maybe go back 14 years.
A few people did, but weren't they kind of still expensive around that time?
Yeah, and they were still messing with phones and so on. So think about that. You didn't have smartphones back then. You go back a decade.
It was the old flip phones.
Yeah. Okay, you didn't have any of that. So, do you see how things progress? Now, I'll be selfish for a minute. Let's take a look at my grandfather. Most people don't know this. My grandfather was a World War I veteran. He wasn't a World War II veteran, and all the teachers at my school, oh, no, son, you must be wrong. No, I'm right, and that's why you're teaching school, and that's why I should be teaching the class instead of you, because you are an assumptive teacher that is cashing a check from the man. But I digress.
Wow.
Well, every teacher that I had, oh, no, son, you're probably mistaken. It's probably World War II. Oh, really? Yeah, I think you should be fired. So yeah, it happened to be that my grandpa was 50 when my mother was born. So that's how it works out, that my grandpa was a World War I veteran, and he died, I think, in 1978. Okay, think about it. That man was a World War I veteran. So what did this person see? He saw World War I, obviously. He saw the Great Depression, lived through it. They homesteaded property here in Washington State. He saw World War II. In between World War I and World War II, well, you had the Depression, but what was worse than the Depression? Dying. That was called the Spanish flu that killed more people than World War I. My grandpa saw the first man on the moon. He saw Franklin. He was alive the day that FDR died, which was, by the way, 1,000 million billion times bigger than the day that Kennedy got shot. It was just that way. It was different. The next biggest thing, I think, would be Kennedy being assassinated. But FDR dying in the middle of World War II, that's a shaking event, okay? So he saw that. He saw the Korean War. He saw the Vietnam War. He saw Watergate. Think of all of the things. He saw the first television. He saw, the first, all of that stuff. I think right at the very end, the CD players wouldn't have been invented. But think of all the different things that my grandpa experienced while he was alive. It would have been, I think, no, not the first airplane, but the first jet.
Oh, yeah.
Okay.
Yeah.
You're talking to nuclear weapons. Just think of everything that would have taken place from before World War I when he was born to 1978. And by the way, he came back from World War I on the USS Arizona, that battleship, before it was sunk at Pearl Harbor. So that man's life, think of everything that he experienced. Of course, there was a lot of low points, but just think of the technological and scientific advances. I didn't even mention the advances in plumbing and the advances in healthcare. Polio was eradicated. You had all of these different wonderful drugs developed, one of them just being plain old penicillin. But, think of that. Think of how much that man experienced in his lifetime. Would you want to own a really, really boring company for my grandpa's lifetime, like a Johnson & Johnson or a Heinz ketchup or a Kraft Foods that did Jell-O or General Mills that would have cereal and all of those things? How about a boring old oil company? How about a telephone company? Can you see as a person that over his life which is 80 some odd years, that you would have wanted to own a good company for that time. So sit back, take a look outside, look how nice the weather is today. Look at how many different things are going on. Look at the computer, the technological, and the healthcare advances out there, and take a step back from the highs and lows and realize that don't be so full of yourself that you think the world is going to end on your watch. It's not going to. A lot of folks, as they age, I think they think that, I'm so important, or this, we're probably
this generation.
Yeah, we're going to see everything go to hell while I'm still alive. And that's just not going to happen. Okay. So when you step back and take a true realistic look, not pessimistic, not optimistic, but a true realistic look at what's going to happen. Let's take Chris's my lifetime. We're probably going to be, hopefully we'll be alive for another 40 years or more. Right?
Sure. Let's say your lifetime.
Nice. Okay.
I got plans later. So.
Okay. So another 40 years. Would you like, if you're older than me, another 20 years, would you like to own some pieces of boring companies, grab their dividends the whole time, and just enjoy the ride of technological advances, even if we're talking like a company like GE, for example?
I was thinking the ride of mediocrity.
Yeah, who cares? But just think of the Costcos that were created and the Walmarts and all of these things that we might not think of as, gosh, I wish I owned that in life. Take a step back. Take a look at it realistically. You don't have to be so optimistic. Just realistically, aren't there some things that you'd like to pieces of businesses that you'd like to own for the future? Guess what? When you talk in terms like that, it's not the wrong time to invest in companies like that, even though we are 5 years away from a market low, and now we happen to be at a market high, and everybody thinks it's the biggest deal since sliced bread. It's just numbers. It's going to happen a lot because in 1982, the market was 1,000. The Dow Jones Industrial Average was 1,000. Now it's 17,000. So between 1982 and now, there's been a lot of days where the market hit a brand new high. And if you decided that that was a reason that you didn't want to own your favorite company, then you're the idiot. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. The telephone number here to the studio, 509-241-5900. We'll be back with Money Market Funds.
This is Smart Investing with Michael J. Wren.
Turns out it was just a ploy to sell me timeshares in Idaho.
No, it's great.
This is Smart Investing.
A division of Taliban Enterprises.
What is this?
It's the old Michael Scott thing. He was all mad at his business.
What's the music?
Oh. You don't remember the old 70s?
Yeah, I guess so. I remember it, but I don't know anything about it. It's not bringing up a name. I just remember, this might sound familiar. I think I used to listen to this out of a 7-Up AM radio can.
Bad Mama Jamma? Really? I got it from Undercover Brother. So.
Okay. Yeah. Undercover Brother. That's what we're going to talk about now on the air. So, what are we going to talk about now? We are going to talk about money market funds. As I said at the beginning of the show, I think that, I think that packaged products are well overused. Now, I don't think that all packaged products are bad. I think that most of them, are just overused, but used in a correct way. I think that a lot of packaged products can be helpful to a person. Where did the packaged products really get their start? Well, the first mutual fund, I believe, was the MFS something fund, started in 1922, 23, or 24. I think the Pioneer Fund from the Pioneer Group of Funds was one of the other older funds that was started 1928 by a guy by the name of Phil Carre. So the mutual fund, as it's known, was started back in the 20s.
I'm just going to take your word for it because I couldn't even fake something like that.
But, they weren't widely used because when you're talking 20s, 30s, 40s, 50s, 60s, 70s, Wall Street investing in and of itself just wasn't done. You're talking about the period that there wasn't Social Security either. So much, much different socially financial landscape than exists today. And so for many, many decades, the sheer fact of investing, it was done by just the very, very elite in the United States. And it wasn't the middle class. By and large, they were not investors. What got the middle class investing? Two men, Bruce Bent and Harry Brown. What did they do? They dreamt up something called the money market. Now, the money market nowadays, everybody thinks of it, and you even hear banks talking about it. And what's odd is the money market fund was originally created so you could put your money in a quasi-savings account away from the damn banks because the banks weren't paying you anything. Okay? What happened? Well, they're taken for granted today, but it's what brought the middle class into the market. It was different economic conditions that came together that created the money market. The little bit of a backstory was that in the 1920s, before the Great Depression, people felt that banks had got into trouble by paying too much in interest to their customers while they were competing for deposits. So the Federal Reserve established a rule. It's called Regulation Q or Reg Q, that capped the interest rate banks could offer in savings accounts. And that was okay for a long period of time because back then, if you go back to the 20s, 30s, 40s, and 50s, and even 60s, interest rates were really benign and low like they are today. So there wasn't a big deal. But from 1950s to the 1960s, the interest rates paid by the banks under Regulation Q rose from 3% to around 5%. Banks at this time, they weren't allowed to pay interest on checking accounts. See how different this is than when you go into some other investor's office and they immediately start talking about blah, 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 and charts and so on. It's much more fun to learn some of the history on this stuff, at least for a nerd like me. Okay, so the interest rates were low, but as long as there was no inflation, there weren't many complaints about Regulation Q. People were completely content to earn that 3 and 5% in a savings account since there was no inflation, and they were at least making money on their money. The country really wasn't thinking of terms of the stock market and double-digit returns because the thought of their money in the bank purely is their savings. They wanted to save it and make a little interest on it. Then inflation came along, and that was accompanied by a gigantic rise in interest rates. Suddenly, 70, you had mortgages that were 12 and 13%. Inflation was climbing past 10%. Yet the money that you had in the bank was still stuck at around 5%, what the bank was paying you in savings accounts under Regulation Q. Up until this time, you as an investor, the people never had to think about interest rates or what was happening to their money, and they suddenly realized that they were being screwed. So most people at this time, what were they supposed to do? Well, a lot of people have heard of something called a treasury bill. Okay, treasury bills were available to investors back then, and treasury bills paid the going rate of interest. Okay, that was about 8% until 1970. So many people, when they had enough money in savings and they wanted to earn more, they would buy a treasury bill. Okay, and you could buy it with as little as $1,000. What happened? Well, as interest rates climbed, many more people were lined up outside the Federal Reserve building when they held their treasury bill auctions because people wanted to buy them because they were getting double the interest sometimes than what they were getting at the bank. Okay? the federal government started to worry about having all of these unseasoned investors holding government paper, and they didn't know what it would do to the banking system. This is the Federal Reserve. Okay, they were also they were concerned about the skyrocketing costs from processing all these increased numbers of transactions. So just think about, you have the huge majority of savers in the United States. All of a sudden, they want to leave the bank and go buy a treasury bill that pays them more money. And the treasury bills typically have maturities of 10 years all the way down to 6 months, maybe sometimes it's 3 months, maybe a month. So you didn't have to put your money away for a long time, okay? What did the Fed do? It was a huge shock to the system. They increased the denomination, the minimum amount that you could purchase a treasury bill for up till 1970 was 1,000. In 1970, they upped it to 10,000. Do you see how that would have just completely shunned? You're talking 1970s monies.
Yeah, okay.
Moving it from $1,000 to a 10 grand?
Does a lot.
Yeah, I mean, you basically wiped out the middle class. That would have been pretty unpopular back then, and I haven't even tried to find newspaper clippings or news.
I can already hear a lot of my friends going, well, that's just for rich people.
Yeah.
Even if they had the money, they wouldn't do it after that.
Okay, so what happened is that these two men by the name of Bruce Bent and Harry Brown, they noticed that there was this huge discrepancy between the savings at the bank and a treasury bill. And they're thinking, okay, the bank is FDIC guaranteed, but the treasury bill, what the heck? It can't be that bad. Under Regulation Q, the banks were paying 5.25%, and treasury bills were trading around 8%. These guys figured there had to be a way to get in the middle and make some money. So they started looking at all the banking laws in the country. They were actually looking for a small, older bank with a charter that wasn't subject to this Regulation Q. They couldn't find it. And then all of a sudden, they had a great idea. They said, why do we have to make it a bank? Why can't we make our new business out of a mutual fund charter? So basically, they chartered a mutual fund that bought nothing but treasury bills of different maturities. And they put it all together, and it was called the Capital Preservation Fund. The average passbook savings account at the bank in the United States at that time was about $3,700. So when the government switched from $1,000 denominations to $10,000 denominations, it flushed all of those investors out of the market. So these guys, Bruce Bent and Harry Brown, they were thinking that, if we can make a mutual fund that just invests in this area, we can give people what they want. We can give them this T-bill rate of return. They can invest with us, and they can leave the bank. The reserve fund is what it was called, and it didn't take off straight away, but then they got written up, and I can't find it in my notes here, but they got written up in some sort of a newspaper that said, here's what's going on. You can get this rate of return, and the mutual fund exploded, called the Preservation Fund. And in my research it says, so why didn't the Federal Reserve just outlaw money market funds the same way it outlawed the $1,000 Treasury bill? Well, the truth is that the mutual funds of these money markets were so blatant to have blatantly tried to skirt federal regulations that they wouldn't have gotten off the ground. But these guys were smart enough that they purposely filed the prospectus paperwork with dozens of other investment possibilities that they wanted to start as well to kind of camouflage it. By the time the money market funds really, really took off, which was 1971 is when it got approved to be in business in October, it really didn't take off until 1974. By the time 1975 turned around, there was hundreds of millions of dollars in this fund, It was too big for the Federal Reserve to outlot.
To knock down.
Yeah.
All right.
And I've got a few other interesting facts when we come back. Well, interesting might be taking a little bit of...
Nerdly interesting.
Yeah, I might be assumptive when I say interesting. I've got a few more facts when we come back from the break. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. Telephone number to the studio, 509-241-5900.
This is Smart Investing with Michael J. Wren.
Graduate of the University of Rangoon and assorted night classes at the Knoxville, Tennessee College of Faith Healing.
This is Smart Investing with Mike Wren and Michael's co-host, Chris Martin.
Oh my God, oh my God, oh my God. This is a whole new level of nerd.
I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT. Telephone number to the studio, 509-241-5900. If you'd like to contact me at my office, the name of the firm is Wren Investment Management, spelled W-R-E-N. That telephone number, 888-747-5181.
And as I was telling you, I mean, Facebook is kind of here to stay for a little while, so I will be hitting our Facebook page a lot more. I'm going to be posting a link to the book that you're reading out of. And also, if you go there, you can see me do that Ice Bucket Challenge in my Star Wars costume.
Cool.
So, if you're looking on Facebook, it's Smart Investing Show. Not that hard to find.
Okay. So with that, I finally found a little bit of my notes. What happened is that Bruce Bent and Harry Brown, they filed their paperwork with the SEC in 1970. By October 1971, it got approved. Nothing happened, and when I was doing my research on it, they were saying that they darn near went broke because nobody really wanted to give their money to them to invest because these people would say, "Oh, we've had our money in this bank for decades. Why would we change now?" What happened was there was a big story written about in the New York Times in early 1973 that talked about their mutual fund would be a good way to earn extra interest on your money. And by the end of 1973, their assets in this mutual fund went from $2 million to $100 million. That's a big deal.
Yeah.
I mean, a huge deal.
I mean, that was an obvious, yeah.
I mean, huge deal. What they said when I was doing this research, they said one of the most interesting facts of the money market funds is that the banks helped educate the public about them, and that Fidelity helped too. Fidelity, I guess, saw this being done. They came out with FDIT, a Fidelity money market account that invested in this stuff. I'm using the term money market, but they weren't called money markets right then. I'm going to get to it. Fidelity started a mutual fund that was run this exact same way, but they put another twist on it. They allowed check writing on this mutual fund, a person to be able to write checks on it. That sounds an awful lot like a bank product, doesn't it?
Yeah.
Okay, so they said since it looked like a bank product, the banks were scared. They decided that they were going to have to compete. So what they did, they created something called the money market. The banks created the name. He said basically they paid money market interest rates based on the Monday's Treasury bill auctions and put that inside a CD, which they could use. It's not a savings account. It's a CD. So it got the banks past this regulation queue. So the banks paid you the T-bill rate on a CD that they issued. The banks called it a money market account. And what they said from then on, that name legitimized the whole thing because all of a sudden, what these two guys, Bruce Bent and Harry Brown, created, all of a sudden what they created became something that was strange. All of a sudden, it was legitimized. The bank said, okay, now we're going to do it too. If you can't beat them, join them sort of a thing.
Oh.
Then you're off to the races. So most people don't realize that money market was the biggest thing. And I remember starting way back when in the mailroom in, I believe it was 1990, people were still talking about the money markets to people then were investing. Because if you remember the late 70s and the early 80s, do you remember how high the interest rates were? Or maybe you don't, but maybe you realize that they were high back then. You heard these older stockbrokers and their clients. I remember when money market funds were paying us 13 and 14% per year when inflation was really, really high and interest rates were high. So people weren't even thinking. When all of this was going on, the public back then, they weren't thinking like investors. They were just thinking, okay, here's this new package product box that I can put money in that I get a hell of a lot of interest on. That isn't owning a business. So what I'm trying to tell you is that these package products that my industry uses so frequently, it's like people wearing underwear. It's like everybody does it now. It was started with these money market funds that really kind of quasi aren't investments in the first place. It's an investment, but it's an investment so far down on the scale of the fixed income side that, you can earn money on your money, but when you add in the inflation rate, you're not making a real rate of return most of the time, which means you're not growing your wealth, which means it's not one of those three things: owning real estate, your own business, or somebody else's business. So that package product worked well because it was truly selling something to you, the public, that you wanted. Making that jump, that intellectual jump from, this money market fund is a mutual fund, this S&P 500 is a mutual fund too, and you can use this too for more long-term growth and to grow your wealth. That's too big of an intellectual jump. And from then on, my industry truly has been on a declining slope of education and of knowing past history. Because wasn't it Mark Twain that said history doesn't repeat itself, but it does rhyme?
Something like that.
Something kind of like that. I think that when you're owning businesses for the long haul, obviously you have to own them for a long time to make a lot of money. If you're owning them for a long time into the future, it just makes sense to me that a person should have a good grasp of the long term into the past, to have some sort of recollection of how businesses go up and down and metamorphosis through the years, and how when you get certain levels and certain large businesses, there's a safety to them a bit. They're not as safe as having a guarantee in a bank, but when you have very, very large successful businesses, they do tend to be insulated from the fear factor that a lot of people can have. And that is what I try to get my clients to concentrate on, is that, look, at these businesses are so big. Do you realize what would have to happen for this business to go away? It'd be something that would be life-changing without historical precedent. And, going back to me talking about my grandfather, you have to have a very, very realistic perspective of what goes on in life. And what goes on in life is that life goes on, and these companies figure out ways to be, systematically, they figure out ways to become more profitable. And those are the ones that you want to own. I'm Mike Wren. It's the show Smart Investing. Thanks again for listening today. Again, the telephone number at my office, if you need to call, is 888-747-5181. Have a very good Saturday.
And don't forget to look us up on Facebook at Smart Investing, the radio show.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.